Warren Buffett is renowned for his insightful perspectives on investing, and one of his most famous maxims highlights the importance of temperament over intellect. He suggests that successful investing relies more on emotional discipline and patience than on raw intelligence. This advice has resonated with countless investors, offering reassurance that you don't need to be a genius to navigate the markets effectively. Instead, maintaining composure during market fluctuations and resisting impulsive decisions are key traits for long-term success. Buffett's words serve as a comforting reminder that sound judgment and steady nerves often outweigh complex strategies or technical expertise. Consider the possibility that a widely circulated quote, often intended to inspire or guide, might be misunderstood in ways that prove harmful. If investors interpret its message too literally or out of context, they may fall into intellectual traps, making decisions based on flawed reasoning. Such misinterpretations can foster overconfidence, encourage risky behavior, or blind individuals to important nuances. The danger lies not in the quote itself, but in how it is internalized and acted upon. By questioning the potential consequences of misinterpretation, we open the door to a deeper, more critical examination of the advice we follow. This approach encourages investors to think beyond surface-level wisdom and seek a more balanced perspective. Investors often latch on to familiar quotes, believing they offer a shortcut to wisdom and success. This psychological tendency can create a false sense of confidence, making individuals feel clever and well-informed. However, this self-assurance can be misleading, as it may encourage risky decisions without proper analysis. The very quote that seems empowering can become a trap, subtly guiding investors toward costly mistakes. Instead of fostering careful judgment, it reinforces biases and overconfidence. As we delve deeper, we'll uncover the central trap that lies beneath this surface-level wisdom, revealing how it can undermine even the most well-intentioned strategies. Consider your own approach to investing. Have you ever held on to an investment simply because it felt comfortable, rather than because you thoroughly analyzed its potential? Many investors rely on temperament, trusting their instincts or emotions, instead of making decisions based on careful research and evidence. Reflecting on these moments can reveal how personal biases and feelings might influence your financial choices. By recognizing these patterns, you can become more aware of the role temperament plays in your investment strategy. This awareness may help you make more informed decisions in the future, balancing intuition with thoughtful analysis. The phrase temperament, not intellect, is often cited in discussions about success and decision-making, but its true meaning is frequently misunderstood. Many people interpret it to mean that intelligence is unimportant and that personality alone determines outcomes. In reality, the concept emphasizes the importance of emotional stability, patience, and self-control, especially in challenging situations. It suggests that while intellect provides knowledge and analytical skills, temperament governs how individuals apply these abilities under pressure. Misinterpretations can lead to undervaluing critical thinking or overestimating the role of raw emotion. Understanding the balance between temperament and intellect is key to appreciating why both qualities matter in achieving long-term goals. Movements such as hodl and diamond hands have become rallying cries in the world of investing, especially among retail traders. These phrases embody a sense of emotional resilience and steadfastness, encouraging individuals to hold on to their assets regardless of market volatility. However, this unwavering commitment often stems from a misinterpretation of Warren Buffett's advice on long-term investing. Buffett advocates for patience and thoughtful decision-making, not blind allegiance to any asset. The emotional fervor behind hodl and diamond hands can sometimes overshadow the importance of fundamental analysis and rational strategy. As a result, the original intent of Buffett's guidance, to invest wisely and with discipline, may be lost amid the enthusiasm of these movements. This myth shifts the focus of investing away from careful analysis and logical decision-making, turning it instead into a challenge of emotional resilience. Investors may feel compelled to endure stress, uncertainty, and market volatility, believing that success depends on their ability to withstand emotional turmoil. As a result, rational strategies and objective evaluation often take a back seat to gut feelings and emotional reactions. This approach can lead to impulsive decisions and missed opportunities, undermining the potential for long-term growth. By framing investing as a test of emotional endurance, the myth distracts from the importance of research, planning, and disciplined execution. Holding on to fundamentally broken or highly speculative assets is often mistaken for having strong investment temperament. In reality, this behavior reflects a misunderstanding of sound investment principles. True temperament involves patience and discipline, but it is grounded in rational analysis and an understanding of intrinsic value. Clinging to assets with poor fundamentals or uncertain prospects is not a sign of emotional strength. Instead, it reveals a lapse in judgment and intellectual rigor. Wise investors distinguish between enduring short-term volatility in quality investments and ignoring clear signs of long-term decline. Ultimately, temperament must be paired with informed decision-making to achieve lasting success. Warren Buffett's quote is often misunderstood, but its true intent centers on the value of intellectual rigor. Rather than simply advocating for reading widely, Buffett emphasizes the importance of thinking critically and deeply about information. He believes that disciplined analysis and thoughtful reflection are essential for making sound decisions. For Buffett, intellectual rigor means questioning assumptions, seeking evidence, and maintaining a commitment to learning. This approach has been a cornerstone of his investment philosophy and personal success. By prioritizing careful reasoning over superficial knowledge, Buffett demonstrates how intellectual discipline can lead to better outcomes in both business and life. Warren Buffett's dedication to intellectual growth has been a defining trait throughout his life. He is renowned for his voracious reading habits, often spending hours each day immersed in books, newspapers, and financial reports. This commitment to continuous learning has shaped his analytical approach to investing, allowing him to make well-informed decisions based on thorough research and careful evaluation. Buffett's method relies heavily on understanding the fundamentals of businesses, rather than following market trends or speculation. By prioritizing knowledge and critical thinking, he has built a reputation for making sound investments that stand the test of time. His lifelong pursuit of wisdom continues to guide his strategies and inspire others in the world of finance. Value investing is grounded in the principle of purchasing securities that appear undervalued relative to their intrinsic worth. This approach emphasizes careful analysis of a company's fundamentals, such as earnings, assets, and long-term prospects. Investors seek to identify discrepancies between market price and true value, often relying on financial statements and industry trends to inform their decisions. The analytical process involves assessing qualitative factors like management quality, as well as quantitative metrics such as price-to-earnings ratios and book value. By maintaining a disciplined focus on objective data and resisting market hype, value investors aim to minimize risk and achieve sustainable returns over time. This intellectual framework encourages patience, thorough research, and a commitment to rational decision-making. Temperament plays a crucial role in investment decisions, often overshadowing technical expertise or intelligence. It is not just about having the right information or analysis, but about possessing the courage to act on that knowledge, particularly when emotions run high. During periods of market panic, many investors are swayed by fear, abandoning their strategies and making impulsive choices. Those with strong temperament remain disciplined, relying on well-founded intellectual analysis rather than succumbing to short-term anxiety. This ability to stay the course and make rational decisions under pressure often distinguishes successful investors from the rest. Ultimately, temperament is the steady force that enables individuals to translate insight into action, even when the environment is uncertain. Warren Buffett's investment in American Express during the salad oil scandal offers a clear example of how intellect precedes temperament in successful decision-making. First, Buffett analyzed the situation with careful reasoning, assessing the company's underlying value despite the crisis. He recognized that the scandal, while damaging in the short term, did not compromise American Express's core business fundamentals. After this intellectual assessment, Buffett's temperament came into play. He maintained composure and conviction, resisting the panic that gripped other investors. By combining rational analysis with emotional discipline, Buffett's approach ultimately led to a highly profitable investment. It is a common misconception that temperament can substitute for intellect, suggesting that personality traits alone determine success or decision-making. In reality, temperament does not replace intellect. Rather, it serves and supports it. Temperament shapes how individuals approach problems, manage stress, and interact with others. But it is the intellect that processes information, analyzes situations, and formulates solutions. When temperament and intellect work in harmony, they enable more effective reasoning and balanced judgment. Understanding this relationship highlights the importance of both emotional disposition and cognitive ability in achieving personal and professional goals. At the heart of many investment strategies lies a subtle trap: the misuse of temperament as a shield. Investors often claim that their temperament, whether cautious or bold, guides their decisions. But this can serve as a convenient excuse for avoiding deeper analysis or challenging their own assumptions. By attributing outcomes to personality traits, they sidestep the rigorous intellectual work required for sound judgment. This tendency not only fosters complacency, but also protects the ego from admitting mistakes or gaps in understanding. Over time, relying on temperament alone can hinder growth and lead to missed opportunities. Recognizing this trap is essential for anyone seeking to improve their investment approach and achieve lasting success. Investors sometimes fall into a psychological trap where they avoid thorough analysis and instead justify their choices by misapplying the idea of temperament. Rather than confronting the facts or evaluating their decisions objectively, they convince themselves that their approach is simply a reflection of their personal style or emotional stability. This rationalization can lead to ignoring warning signs and repeating mistakes. By conflating temperament with sound judgment, investors may sidestep critical thinking and fail to learn from past errors. Over time, this pattern can undermine their ability to make informed decisions and achieve consistent results. True temperament is often misunderstood as simple stubbornness or an inability to adapt when faced with setbacks. However, temperament refers to a person's consistent emotional response and resilience, especially under pressure. Unlike stubbornness, which is a refusal to change regardless of circumstances, genuine temperament involves thoughtful persistence and the ability to learn from losses. Paralysis, on the other hand, is characterized by inaction and indecision, often resulting from fear or uncertainty. A person with true temperament remains composed and proactive, using challenges as opportunities for growth. This distinction is crucial as it highlights the value of adaptability and emotional stability over mere resistance or avoidance. True temperament in investing is not just about staying calm during market fluctuations. It also involves the courage to acknowledge when you've made a mistake. This means being willing to act on new information, even if it requires selling an asset at a loss. Admitting errors and adapting to fresh insights is a sign of intellectual honesty and resilience. Rather than clinging to past decisions out of pride or fear, real temperament enables investors to make rational choices that reflect current realities. In the long run, this approach can help preserve capital and foster better decision-making. The concept of false temperament can be a subtle yet significant pitfall for investors. It describes the tendency to mistake inaction for wisdom, believing that simply holding on to an asset through adversity is a mark of patience and virtue. However, this mindset can lead investors to ignore warning signs and hold assets as their value declines, sometimes all the way to zero. Rather than making thoughtful decisions based on changing circumstances, they remain passive, convinced that endurance alone will yield positive outcomes. In reality, discerning when to act and when to hold is crucial, and blind inaction can be just as risky as impulsive trading. Recognizing the difference between genuine patience and misplaced stubbornness is essential for long-term investment success. As we continue this discussion, it's important to remember how it aligns with our channel's core mission. We strive to promote safety, peace of mind, and simplicity in every financial decision you make. By providing clear information and practical guidance, our goal is to help you feel confident and secure in managing your finances. Whether you're planning for the future or navigating everyday choices, we believe that financial well-being should be accessible and stress-free. Our commitment is to support you with resources and insights that make the process easier and more reliable. The central lesson is that genuine safety and peace of mind are not simply given, they are earned. Achieving these states requires patience, which itself is cultivated through dedicated and rigorous intellectual effort. By engaging deeply with challenging ideas and embracing the discipline of thoughtful inquiry, we build the resilience and calm needed to face uncertainty. This process transforms fleeting comfort into lasting assurance. Ultimately, true peace is the result of persistent learning and the patience that grows from it. To succeed in investing, start by building a strong foundation of knowledge. Understand the principles, strategies, and risks involved before making decisions. Once your intellect has guided your choices, it's your temperament that will help you stay the course during market volatility. Emotional discipline is essential when markets fluctuate, as it prevents impulsive reactions and helps you stick to your long-term plan. By combining careful research with steady resolve, you can navigate uncertainty and work toward your financial goals.